Good evening, friends. Good evening, friends. Please settle down. Stop talking, please. In the previous class, we are doing the area break-even point in marginal costing. Stop talking, please. Settle down. Settle down. Those who come late, please, without any noise, settle down calmly. Those who are already there, stop talking. Let's start the class. Please. Shh. So, we are doing the issues regarding break-even point in marginal costing. In which, last class we did question number 9 involving marginal costing versus absorption costing break-even point. The problem has been completed, but notes has to be written for the discussion made in that sum. We'll do question number 8. Once again, it is a marginal costing versus absorption costing break-even point. Another angle we'll be discussing in question number 8. Please. Once we complete 8 and 9, we'll do the question number 10, a past examination question regarding the break-even point calculation when you have a product mixer. Then we'll start with the concept called as indifference point in today's class. We'll be having a brief introduction to indifference point. If possible, try to cover 2 basic problems and have a start with the big problems in the indifference point concepts. Now, let us first summarize what is done before I proceed further. First, we discuss about the basics in marginal costing. We saw the income statement, sales minus variable cost is equal to contribution minus fixed cost gives you profit. PV ratio is contribution per unit divided by selling price or contribution divided by sales, or fixed cost divided by break-even sales, or profit divided by margin of safety. Break-even sales is the sales level at which the profit is 0. Contribution equals fixed cost. Sales equals the total cost. It can be expressed in units as well as in rupees. Break-even point in units is fixed cost divided by contribution per unit. Break-even point in value is break-even point in units into selling price or fixed cost divided by PV ratio. Margin of safety is the sales above the break-even sales. The sales that can drop before the company starts incurring losses is a profit generating sales. Margin of safety also can be expressed in units as well as in rupees. Okay, please. Don't eat. Okay, can I proceed? Please. Margin of safety in units, please. Can I proceed? Please settle down, please. Actual sales in units minus break-even point in units. Profit divided by contribution per unit. Margin of safety in rupees is margin of safety in units into selling price. Actual sales minus break-even sales, or profit divided by PV ratio. Sales gives you contribution, in which break-even sales contributes for fixed cost. Margin of safety contributes towards the profit. Profit is equal to sales minus cost, or contribution minus fixed cost, or margin of safety in units into contribution per unit, or margin of safety in rupees into PV ratio. All these are very introductory or basic level issues which we done in the IPCC itself. All these formulas assume a linearity. When I say linearity, the volume changes, these things should not change. What should not change? Per unit selling price, per unit variable cost, total fixed cost. When all this does not change with the volume, then we can boldly apply these formulas and arrive at the numbers which are desired. But if the linearity assumption is broken, what happens to the chapter only will be purely discussed as the final level. In final level, we will always challenge the linearity and then analyze what is going to happen to the numbers. This is the trend we will be seeing in each and every problem which we are doing in the final workbook. Okay, here, first of all, we started discussing about the concept of break-even point. Here we saw various situations where break-even point is not equal to fixed cost by contribution per unit. What are all the situations we started discussing? First, when we have a step fixed cost. Step fixed cost means a fixed cost is same only for a range. When it crosses a range, the fixed cost increases. In such a scenario, we always have a chance of having a multiple break-even point, where we should try to understand the break-even point range by range. We did two problems in that regard. One is that 0 to 16,000 units, 16,000 to 60,000 1 units and so on, where we have two break-even points. Remember or not? Another is a SCV problem. That is a SCV problem that subscribers, the 10,000, 20,000, 30,000 subscribers, that we did not have the multiple break-even point. The reason is what? The second range profit was able to fully recover the third range incremental fixed cost. But still, we cannot say that the high volume profit will be what? Higher. So that is seen through the two problems in multiple break-even points. So when you have a step fixed cost, one thing is sure, when volume increases, one cannot say profit is going to increase also. Beyond stage of volume increase, we have to incur a incremental fixed cost. Again, profit is going to be brought down. Once again, we have to start earning it. Everybody following or not? This is what has been learned in those two sums. Then we did that number of students problem, Kalyan University problem, where there also we cannot simply say break-even point is equal to fixed cost by contribution per unit, because in that an interesting feature is supervision cost. It is predominantly variable. It predominantly what? Variable. But over a small range, it remains what? Fixed. That is 100, 200, 300, 5,000, 6,000, 10,000, always in multiples of 100, it is going to what? Vary. But within a small range of 100 remains what? Fixed. In such a case, what we assume is, first we assume it to be variable and in multiples of 100. When you get a BEP which is not in multiples of 100, for the odd numbers, we are going to adjust for the extra fixed cost to be recovered and find out the right break-even point is what has been discussed in that particular sum. Respond, are you following or not? Now, all these are hit concepts. Are you able to grasp or not? No. Problem solving, again, I am not saying that is alone important. I am just showing you the difference between each and every problem. Step fixed cost and a fixed cost in small range. Both need not have what? Same type of working. The approach to some should be, say, drastically changing. Can I proceed? Now. Then we started discussing about marginal costing versus absorption costing break-even point. That will be predominantly doing in today's class along with the other issues. Can we start or not? Now, in that, let us summarize what is done in question number 9 and marginal costing versus absorption costing concept as it is. Tell me, cost is classified into two types. All of you please participate. What are two types of cost? Product cost and then what? Period cost. Product costs are considered for stock valuation. Period costs are not considered for stock valuation. Period cost expires fully in the same year. Product cost partially go to the next year via stock. Everybody following or not? No. We also saw that profit is not is equal to sales minus cost. Profit is equal to sales minus expired cost. Once again, tell me, what are the two types of cost? Already I told here. Tell me, what are two types of cost? Manufacturing and non-manufacturing cost. All non-manufacturing costs, administration, selling, whether they are variable or fixed, is always what? Period cost. Manufacturing costs we classify into three: material, labor, overheads. Overheads further into variable and fixed overheads. Respond yes or no? No. In that, regarding material, labor, variable overheads, no doubt at all, they are always what? Product cost. The problem of discussion is only what? Fixed overhead. Is a fixed manufacturing overhead product cost or period cost? Tell me, product or period. Absorption costing system says it has what cost? Product cost. And marginal costing system has a period cost. Everybody respond yes or no? No. That means tell me, in absorption costing system, if I want to value 1 unit of the stock, I'll value the stock at selling price or cost price or cost price. Total cost of manufacturing cost, manufacturing cost. What manufacturing cost? Full manufacturing cost will be taken. Able to recollect or not? Tell me, what is the full manufacturing cost of this particular product? Metal inside it, labor inside it, variable overheads inside it, as well as unitized fixed manufacturing overheads. When a unitized, that is the word unitized means what? Calculate per unit. What is the rate I have to use? Actual rate or standard rate? Standard rate. What is the standard rate formula? BFO divided by BO. Budgeted fixed overheads is what we normally budget at the beginning of the year. BO is what capacity? Normal capacity. If they don't give normal capacity, 100% capacity can be taken as the normal. Using standard rate, I give the fixed cost to the actual units produced. Every mouse produced, I give what? A share of fixed cost, a standard rate. At the end of the year, for how many units produced? Actual output produced, I would have absorbed what rate? Standard rate. That is what we call as the absorbed overheads. In absorption costing, the actual and absorbed may be different. The difference we call as what? Under absorption or over absorption. If they don't give you actual overheads, we can presume it to be same as what? Budgeted fixed overheads also. Marginal costing, it is very quite simple. The stock is valued at variable manufacturing cost. So it is having material, labor and then variable overheads. Fixed manufacturing overheads along with the other non-manufacturing cost is treated as a period cost. Yes or no? No. Next, income statement, we had a format or not? Tell me, absorption costing income statement format. A. So by A, what is what? Sales minus cost of goods sold gives you gross profit, minus administration and selling expenses, minus under absorption or plus over absorption gives you the profit. Tell me, cost of goods sold breakup. Opening stock of finished goods and cost of production minus closing stock of finished goods. The opening and closing stock should be valued at what cost? Full manufacturing cost. Remember or not? Now, next we discuss about the marginal costing income statement. Tell me the format. Sales minus variable cost of goods sold, that gives you gross contribution, minus variable selling and administration, that gives you contribution, minus fixed cost gives you the profit. Respond yes or no? No. Fixed cost means fixed what cost? Manufacturing, administration and then what? Selling expenses. Now, marginal costing profit, absorption costing profit will be same or different? Same when there is no stock or the net stock is zero. Different when you have what? Net stock. Net closing stock now which shows more profit? Absorption costing. Net opening which shows more profit? Marginal costing. That difference in profit is due to under absorption or over absorption? No. It is purely due to what? Stock valuation. Exactly corner different. What a difference here? Fixed cost inside the net stock will be the difference in profit. Respond yes or no. Having the clarity here? Now, in that case, we all now came to know that when there is a stock, when there is what? Net stock, absorption costing profit is different, marginal costing profit is what? Different for the given sales level. Yes or no? Suppose I calculate break-even point using marginal costing formula, fixed cost divided by what? Contribution per unit. At that sales level, marginal costing system gives you zero profit, right or not? Right or not? At the same sales level, should absorption costing profit be zero? Not necessary when you have a stock. So in that case, absorption should be having a different sales level that gives it what? Zero profit. That is what we call as absorption costing break-even point. Who uses marginal costing break-even point? Who uses absorption costing break-even point? What are the advantages, disadvantages? All we'll be discussing in today's class at the end of the next problem. Everybody following on? But understand that there exists another break-even point called as what? Absorption costing break-even point. Till now, whatever we are calculating is what break-even point? Marginal costing. Fixed cost divided by contribution per unit. Now, last class we discussed about the absorption costing break-even point. My question is, in that question number, question number 9, just to summarize, to have a continuity, can I say? Now, in the question number 9, we had a manufacturing fixed cost of 8,40,000 and a non-manufacturing selling fixed cost of 2,40,000. Tell me, what is the total fixed cost of the company? 10,80,000. The current year fixed cost is 10,80,000. Am I right or not? No. In absorption costing, should I recover the entire 10,80,000 to have zero profit? Not necessary, because when there is a net increase in stock, Through star, a portion of the fixed cost escapes to the next accounting period. Right or not? In that case, I don't have a necessary to recover what? 10 lakh 80. It is enough if I recover only what? That fixed cost which has to be recovered this year. Respond yes or no? No. In the problem, if you remember, every unit produced will be having how much fixed cost absorbed here? 1.4. You all remember the number? No. Just a minute. Just want to have a confirmation. Don't shout and all. Those who revise that sum before coming to today's class, raise your hand. Okay. No talk. I only asked to raise a hand. Okay. I expected. Can I go see it? No. Please. Shh. How many times I can tell? Please. Had you revised now, today when I continue, you'll be having a full grip over the discussion. Yeah. Are you all following? Now, I am not giving you unnecessary work. You should understand it. Okay, no need to waste time. Any number, any amount of advice is an idle advice. So no. Come back, please. Shh. Settle down. No, I don't want any disturbance. Today some very important issues are going to be discussed. Can I proceed on? No. Please. Shh. 1.4 rupees. That is every unit when I produce, I charge it. You know how much fixed cost here? 1.4. Tell me. The stock was opening 30,000, closing how much? 40,000. Stock increase or decrease? Increase. That means what happens is 10,000 unit stock increase takes into it how much rupees fixed cost? 14,000. And every unit takes for 1.4 rupees. It takes 14,000 into it. The fixed cost it carries from this year to what? Next year. But this year I don't want to recover 10 lakh 80,000 rupees fixed cost in my P&L account. I should recover only how much? 10 lakh 66,000 rupees. The reason is very obvious because for me to have an absorption costing profit as zero, I need not recover the entire fixed cost. I only have to recover the fixed cost of goods sold. Everybody, are you following what I am saying? In such a situation, we saw how to calculate the break-even point. So the fixed cost to be recovered is 10 lakh 66,000. And what is the contribution? 2. Tell me how I got 2 rupees. 10 rupees selling price, 6 rupees variable manufacturing cost, 2 rupees is a variable selling cost. So 2 rupees to recover 10 lakh 66,000 units. He is going to how much as break-even point? 5 lakh 33,000 units as a break-even point. Accept or not? When I sell 5 lakh 33,000 units, my absorption costing profit is what? 0. I need not do the problem once again. We saw how the profit is 0. Okay. Now, my question back is, suppose I have a net opening stock. I have what? Net opening stock. In that case, absorption costing break-even point increases or decreases or increases. Because I not only have to recover the current year fixed cost, I also have what? A carry forward fixed cost from the previous year. To put it simply, let us have the formula like this. Absorption costing break-even point is equal to fixed cost. Is equal to what? Fixed cost. Plus or minus. Fixed cost what? Plus or minus. Fixed cost inside stock divided by what? Contribution per unit. Agreed? Formula agreed? Yes, tell me, absorption costing break-even point is equal to, tell me the formula. Fixed cost plus or minus fixed cost inside net stock divided by what? Contribution per unit. My question is, I said plus or minus, na? Can I put a toss and say plus or minus? No. You understand when to add, when to subtract. Suppose it is a net closing stock. Net closing stock. Add or subtract or subtract. In a part of it escapes to what? Next year subtract. Net opening stock means what? Add. Because current year fixed cost and net fixed cost from the previous year should be recovered. So add if it is a fixed cost in net opening stock. Subtract the fixed cost inside what? Net closing stock will give you the absorption costing break-even point. Everybody accepting it or not? No. Marginal costing break-even point is as usual. It's going to be fixed cost divided by what? Contribution per unit. I don't need to worry about fixed cost inside net stock. The reason is what? It is not there inside the net stock. Everybody yes or no? So it's a normal break-even point calculation. Please tell me yes or no. Okay, now let us have a brief notes up to what has been discussed. Because notes I am giving particularly for you to have a revision later. Then we can go to the next problem, much more interesting regarding marginal costing versus absorption costing break-even points. Write down notes. Stop talking. Settle down. Please. Write down notes. Point number 1. Settle down. Point number 1. So, just a minute. I don't want to dictate notes for marginal costing versus absorption costing, which I have already given in the standard costing chapter. Remember or not? Yes, now, who said no? Raise your hand. I gave you a written. I have to discuss only the remaining portion regarding the break-even point issue. Write down point number 1. It is known that, point number 1, it is known that at a given sales level, it is known that at a given sales level, marginal costing income statement, it is known that at a given sales level, marginal costing income statement and absorption costing income statement at a given sales level, marginal costing income statement and absorption costing income statement reports at a given sales level, marginal costing income statement and absorption costing income statement reports, same or different profit? Different profits, reports different profits when there exist stocks. When there exist stocks. No stock, they will obviously report what? Same profit when there exists stock. Can I proceed? Point number 2. This means when there is stock, comma, the sales level at which, when there is stock, the sales level at which marginal costing reports zero profit, when there is stock, comma, the sales level at which the marginal costing reports zero profit, when there is stock, the sales level at which the marginal costing reports zero profit will not be the sales level at which the absorption costing has zero profit. Will not be the sales level at which the absorption costing has zero profit. Will not be the sales level at which the absorption costing has zero profit. Absorption costing has zero profit. You understand the sentence or not? Now, see, what is break-even point? Sales. At which the profit is what? Zero. For a given sales level, if the marginal costing profit is zero, for the sales level, absorption costing profit will not be what? Zero. When I have a stock, is what I dictated now. Everybody yes or no? Continue. Thus, same point continue. Thus, break-even point is different. Break-even point is different for marginal and absorption costing. Break-even point is different for marginal and absorption costing. Break-even point is different for marginal and absorption costing. Can I proceed or not? Next. Point number 2 or 3? 3. In absorption costing system, the sales need not recover. In absorption costing system, the sales need not recover the entire current year's fixed cost. In absorption costing, the sales need not recover the entire current year fixed cost. When there is, the sales need not recover the entire current year fixed cost. When there is, if you all away, fill up the blanks. When there is dash, net closing stock. The sales need not recover the entire current year's fixed cost when there is net closing stock. Because that portion of fixed cost inside the net closing stock, that portion of fixed cost inside net closing stock, please close the door, that portion of fixed cost inside net closing stock escapes to next year. That portion of fixed cost inside net closing stock escapes to next year. So in exam and all, don't write escape and all. I'm just only telling you in an animated form. Escapes to next year. Please. Again, escapes to what? Next year. In this problem, out of 10,80,000 fixed cost, in this problem, out of 10,80,000 fixed cost, 14,000 goes to next year. In this problem, out of 10,80,000 fixed cost, 14,000 rupees goes to next year. What needs to be recovered is only 10,66,000. What needs to be recovered is only 10,66,000. What needs to be recovered is only 10,66,000. Everybody, I think you are comfortable or not? Next. Point number 3 or 4? Point number 4. Similarly, when there is net opening stock, the sale should recover. Similarly, when there is net opening stock, the sales should recover not only the current year fixed cost. When there is a net opening stock, the sale should recover not only the current year fixed cost, but also a portion of what? Fixed cost from previous year. But also a portion of fixed cost from previous year. I hope everybody following or not? Now, next point, 4 or 5? Fine. Thus, when stocks are given, absorption costing break-even point is calculated as follows. Thus, when stocks are given, absorption costing break-even point is calculated as follows. When stocks are given, absorption costing break-even point is calculated as follows. Absorption costing break-even point is calculated as follows. Branch it into 2. When stocks are given, absorption costing break-even point is calculated as follows. Please branch it into 2. First branch, net closing stock. Second branch is net opening stock. Net closing stock, net opening stock. Net closing stock, net opening stock. Net closing stock, put a down arrow mark and write. Formula BEP is equal to total fixed cost. Why I use the word total fixed cost? Fixed manufacturing cost, fixed non-manufacturing cost. Yes or no? Total fixed cost. BEP is equal to total fixed cost minus what? Fixed cost in net closing stock. Total fixed cost minus fixed cost in net closing stock. Total fixed cost minus fixed cost in net closing stock. Whole divided by fill in the blanks. Contribution per unit. Whole divided by contribution per unit. Whole divided by contribution per unit. Respond, yes or no? Now, second branch. BEP is equal to, total fixed cost. BEP is equal to total fixed cost. I want you to expand plus what? Fixed cost in net opening stock. Total fixed cost plus fixed cost in net opening stock divided by contribution per unit. Total fixed cost plus fixed cost in net opening stock divided by contribution per unit. Concept that has been discussed, has been dictated. Respond, yes or no? Now, one more last point. Point number 5 or 6? 6. Point number 6. We can observe that we can observe that at absorption costing break-even point, we can observe that at absorption costing break-even point, we can observe that at absorption costing break-even point, that is how many units? Tell me. Tungadaya, we can observe absorption costing, how many units? 5,33,000 units. At absorption costing break-even point, that is 5,33,000 units. Come on. The absorption costing profit is, at absorption costing break-even point, 5,33,000 units. The absorption costing profit is, tell me what absorption profit? 0. Then only that can be called as what? Break-even point. The absorption costing profit is 0 and the marginal costing loss is 14,000 exactly, and the marginal costing loss is 14,000 and the marginal costing loss is 14,000. The marginal costing loss is 14,000. Everybody that side, are you following or not? Next. Write down. Similarly, continue. Similarly, at marginal costing break-even point, similarly, at marginal costing break-even point of, I want the answer. At marginal, how many units? 5,40,000 units. Similarly, at marginal costing break-even point of 5,40,000 units, 5,40,000 units. Can I proceed? The marginal costing profit is, the marginal costing profit is how much? 0. The marginal costing profit is 0 and absorption costing profit is 14,000. The marginal costing profit is 0 and the absorption costing profit is 14,000. And the absorption costing profit is 14,000. And the absorption costing profit is 14,000. Respond yes or no. Full stop. Continue same point. To conclude, from this I dictated two issues or not. Tell me what you are going to conclude what? Absorption costing is always what? 14,000 more than what? Marginal costing. To conclude, absorption profit is always, to conclude, absorption profit is always 14,000 higher than, to conclude, absorption profit is always 14,000 rupees higher than, 14,000 rupees higher than what? Marginal profit. Is always 14,000 rupees higher than marginal profit because of, tell me why? Because of what? Fixed cost inside net stock. Because of fixed cost inside net stock. Because of fixed cost inside net stock. In bracket la, what is that here? 10,000 units into how much is inside every unit? 1.4. 10,000 units into 1.4 is equal to 14,000. 10,000 units into 1.4 is equal to 14,000. Bracket close. I want a confirmation. Everybody, those who understood till now this issue, what has been discussed, raise your hand. I think you are fully understood or not? Now, let's go to the next issue. Please. This is an examination sum, but we have settled down. Stop talking. Listen. This is an examination problem in marginal costing versus absorption costing. But there is another problem. There is the original problem in Drury. Appendix to the chapter they given this particular discussion. Generally appendix problems, concepts are all not forming part of the main discussion. There are higher discussions are somewhat unique ones. So in that appendix, when they are discussing about the marginal costing versus absorption costing, they gave another angle to the same discussion. What it is going to be the next problem. Okay, this type they ask in the examination or not. So any type they can ask the other type also in the examination. These are the only two types of problems in this area called as marginal costing versus absorption costing. The other one is much more complicated, much more interesting. That is much more practical also how the managers use that particular concept. Can we start or not? Now let us see what is happening in this sum, what is going to happen in the another sum. Okay, so that we'll know the difference between the two sums to be discussed and then go for the other area discussion. Can we start or not? Now, see. there is a triangle which are very much interrelated. Okay. One is sales, another is production. Guess here, third is what? Stock. Volume nale only these three things. What are three things in volume here? Sales, production, and then what? Stock. Okay. I produce, then I'll be selling, I'll be having what? Stock. If production is more than sales, if a production is what? More than sales, the stock will increase. Production is less than sales, possible? Who said no? Yeah. Production less than sales, possible? Yes. In that what? I'll be using up the opening stock. The stock will what? Decrease. And these are the three things. Okay. Sales, production, and then stock. Understand that we are always calculating sales. The issue is break-even sales. We are always calculating what? Sales. We calculated sales in the last sum given the stock portion. Where production was a balancing figure. For example, I said break-even sales is 5,33,000 units. When the net stock is how many units? 10,000 units. Then I said production is how much here? 5,43,000. Obvious, yes or no? Now, they gave you the net stock. Remember, they gave you what? Net stock. And we calculated what? Break-even sales. And the production happened to be what? A balancing figure in the previous sum. Response, yes or no? In the next sum, they'll give you the production. They'll give you what? The production. We have to calculate what? Sales. We have to calculate what? Break-even sales. Given the production, I have to calculate the break-even sales, but the net stock will become what? The balancing figure. Did you understand the discussion or not? Now, in the previous sum, they said opening stock 30, closing stock 40. They said we want to have a stock increase of 10,000. Net stock number given the question or not? Then we calculate a break-even point. The formula is what? Total fixed cost plus or minus fixed cost in say net stock divided by what? Contribution per unit. For doing the calculation, production not required. So we calculated the break-even point. Once I calculated break-even point, I got what? Sales. What is so sacred about the sales here? At the sales, the profit is what? Zero. And then I just add what? Production as a balancing. When I sell 5,33,000, when I want to have what? 10,000 units net closing stock, then I should have produced what? 5,43,000. We prepared an income statement to prove the profit as zero. Response is or no? No. Suppose the question says, I have to produce how many units? 5,43,000. They have not given sales. They have not given what? Net stock. They have not given what? Net stock. Given the production, they said, I want to produce what? 5,43,000. Please calculate break-even point. Now, I have to calculate what? Sales. At least 5,43,000. Production gives you what? The zero profit. The balancing figure will become what? Net stock. Everybody saw no. So, how to calculate break-even point? When production is given, and where we have to find out the sales and the net stock is going to be the next problem subject matter of discussion. Everybody following or not? Now, they're much more complicated because logically simple, because total fixed cost need not be recovered. I know my stock. What is going to escape to what? Next year I know it or not? I know the stock and I also know what? Total fixed cost. I can easily find out what is the recoverable fixed cost, find out the break-even point. The earlier problem is not a great deal at all. Are you following or not? But in this problem, I don't know the stock. I don't know how much is going to escape to next year. Because I know only the production, I don't know what? Stock. You can say, sir, sales when production is what? Stock. The sales is has to be what? Found out break-even sale. Yes or no? I know only production. I don't know how much fixed cost goes to what? Next accounting period. Still have to calculate what? Break-even point. How to calculate will be the next issue. That is going to be done through question number 8. Now we are doing question number. Now we are done question number 9. Yeah. Okay. We are going to do question number. I am going to do using question number 8. Now, see question number 8. Yes or no? Now, how to do it will be the issue. Can I start doing it or not? No. Please. Shh. Stop talking. We are going to have a very elaborate discussion about this particular problem. Once again, important. Don't think that, sir, all this when it is asking exam, why it is asked, that should not be the issue always. When something is there in a chapter, it should be what? Read. Because nobody expected, till that May 2010 examination, nobody thought they'll be asking a marginal costing versus absorption costing break-even point. Just to share, Even though we have been doing that for so many years, it is a very interesting concept. Institute did not want to ask. Once I ask a question in the first area, it can be any time. They can be asking a question from what? The next slot also. And these are the only two slots in this particular area called as marginal costing versus absorption costing. So mark it as important. Can we start or not? Now. Following is the production and sales given for the 6 periods. Period 1, 2, 3, 4, 5 and then 6. Sales 1,50,000, 1,20,000, 1,80,000, 1,50,000, 1,40,000, 1,60,000 units. And understand everything in what? Units. Production is given as 1,50,000, 150, 150, 150 and then 170 and 1,40,000 units. Other details, selling price 10, variable manufacturing cost 6 rupees, fixed manufacturing cost, budgeted and actual, it is 3 lakhs. If they don't give, we can understand that budgeted fixed cost is same as what? Actual fixed cost. In standard costing terms, we don't have what variance? Fixed overhead, expenditure variance. Non-manufacturing overheads is 1 lakh. Fixed non-manufacturing okay, what about? Right, oh, can I proceed? So, non-manufacturing overheads is 1 lakh. Budgeted activity level is 1,50,000. Tell me, I will budget abnormally or normally or normally. This budgeted activity level only we call as a normal capacity. This used as a denominator to calculate the absorption rate. Innapa, right or not? BFO by BO means a BO is how many units? 1,50,000. Calculate BEP under absorption costing and marginal costing system for all the periods. Okay, please. Can we start now? My question is, to answer this question, the sales units are required or not required? To answer this question, they ask you to find out break-even point for the firm or not. To calculate break-even point, is sales required or not required? Not required. Because I am going to calculate sales only. I am calculating only what sale. These sales may give me profit. These sales may give me what? Loss. I don't know. But I want to find out that special sales. That means the profit is what? 0. Break-even point question. Sales is not important because I am trying to calculate what? Sales only. So this number you need not look at it because I don't want it. I want to calculate only what? Break-even point. First year I wanted to produce 1,50,000. What is going to be the break-even point? If I sell so much, the balance will become what? Margin of safety. Like that, every year they ask you to calculate the break-even point for the first 6 years. 1, 2, 3, 4 years, it is 1,50,000 production. 5 and 6 the production is going to be 1,70,000 and 1,40,000. So sales is irrelevant because the question is all about calculating sales. What sales? Sales, what is the profit is 0. So don't get confused by the first part of the question or the first number. Given only to confuse you. Everybody, can I start or not? Now. Let us have the facts written before you go for the solution. Can you start or not? Now, write down facts. Stop talking, please. Facts. Once you have the numbers in hand, clearly you can easily understand the calculations. Stop talking. Facts. Now answer along with me. Selling price. What selling price of this company's product? 10 rupees. Selling price 10. Variable cost. What is the variable manufacturing cost? 6 rupees. Variable manufacturing cost is 6 rupees. Next, what is the fixed manufacturing? FMOH means what? Fixed manufacturing overheads. What is the fixed manufacturing overheads? 3 lakhs. So, don't write as VC, better write as VMC. VMC means what? Variable manufacturing cost. Like that, I can just write it better, okay? VMC, 6 rupees. Please, fixed manufacturing overheads, how much rupees? 3 lakhs. Fixed non-manufacturing cost, FNMC, fixed non-manufacturing overheads, FNMOH, how much rupees here? 1 lakh. Fixed non-manufacturing overheads, 1 lakh. Fixed non-manufacturing overheads, 1 lakh. units produced. How many units I am producing? 1 to 4 periods. I am producing 1,50,000 units. Year 1 to 4, I want to produce 1,50,000 units. My production target. Okay. Year 5, I want to produce 1,70,000 units. Year 5, I want to produce 1,70,000 units. Year 6, I want to produce 1,40,000 units. Able to locate the numbers or not? So the production targets are 1 to 4 years 1,50,000, year 5 1,70,000, year 6 1,40,000 units. Clarity Rakaba? Now. UD means denominator units. That is, for calculating absorption we use a normal capacity, right? Write down UD in bracket, right? Denominator level unit. UD in bracket, right? Denominator level unit or normal capacity. UD, denominator level unit or normal capacity. Tell me how much the normal capacity? 1,50,000 units. I may produce 1,70,000, I may produce 1,40,000, but I always absorb for how many units? 1,50,000 units as an absorption rate, denominator level units. UP means what? Units produced, and UD means what? Denominator level units. And variable manufacturing cost has been given. Everybody, can I proceed? Now. They ask you to calculate what? The break-even point under what system? Absorption costing system. Please. Okay. I will put a formula and then discuss the logic of the aforesaid formula before we go and solve this particular problem. Can I start with the formula or not? No. Okay. Leave that here. BEP is equal to TFC minus FMOH by UD into UP divided by SP minus VC minus FMOH divided by UD. Is the calculation of what? Break-even point. Okay, copy this. Write down. Break-even point formula. Underline that. Break-even point formula. Now, you may sometimes wrongly divide it, so I'll write it here. You can copy from the sheet. Okay. Better for your convenience when I'm doing. Okay. Break-even point is equal to TFC minus. Please write along with me. TFC minus FMOH divided by UD into UP. TFC minus FMOH by UD into UP whole divided by SP minus selling price minus VC minus FMOH divided by UD. Selling price minus variable cost minus FMOH divided by UD. Why I wrote is the UD should be divided only for what? FMOH, not for the entire numerator. Yes or no? Similarly, here also it is FMOH by UD into UP is a separate issue. Can I proceed or not? Write down. TFC. I think I finished copying the formula. Please copy it quickly. Can I proceed? Please. Where, do you have to explain the abbreviation or not? Where TFC is equal to total fixed cost. TFC is equal to total fixed cost. Bracket la FMOH. What is FMOH? Fixed manufacturing overheads plus FNMOH. Means what? Fixed non-manufacturing overheads. So manufacturing as well as non-manufacturing cost, if we add it, we will be getting the total fixed cost. FMOH plus FNMOH. Can I proceed? Now, next. UD is equal to normal capacity. UD is equal to normal capacity. UD is equal to normal capacity or denominator units. D stands for denominator, U stands for units. Normal capacity or denominator level units. Denominator level unit. Because we always absorb at not actual capacity. At what capacity? Normal capacity. UD is denominator level units. Next. VC is equal to what? Variable cost per unit. VC is equal to variable cost per unit, which is equal to VMC. VMC means what? Variable manufacturing cost plus VNMC, variable non-manufacturing cost. We have a variable selling expense or not? It is possible or not? So variable manufacturing cost plus variable non-manufacturing cost gives you the VC, variable cost per unit. SP and all you need not have, you know it. SP means what? Selling price. FMOH means fixed manufacturing overheads. FNMOH means what? Fixed non-manufacturing overheads are all self-evident. Everybody is or no? Now, this is the formula for calculating the break-even point. The formula for calculating the break-even point. Now, let us by heart this formula and then see what this is all about and then go for the solution to that problem. We'll derive this formula and then go for a solution. The derivation is made to strengthen your knowledge on marginal costing versus absorption costing. Okay. Now, break-even point. Don't talk. Look at me and tell me. Break-even point is equal to what? Total fixed cost TFC minus FMOH divided by UD into UP whole divided by selling price minus variable cost minus FMOH divided by UD. Is the formula there in your mind or not? No. We are not using BEP is equal to fixed cost by contribution has not been used. We use what? A different formula. The final level discussion. Everybody is not know. So now we know how to calculate BEP. In this formula, is stock there or not there or not there? It uses what? Production. When production is given in absorption costing, this is one should be calculating what? The break-even point is the answer. Response is or no. Can I proceed further? Now, let us see the logic or understanding of this particular formula. Okay, now, don't get irritated. You dictate me the previous sum, income statement under absorption costing so that I can help you to understand the formula calculation. Can I say? Last sum, absorption costing break-even point was 5,33,000 units. And we calculated an income statement where we reported zero profit for the 5,33,000 units. Now, can you tell me how it should be done? Tell me one by one, please. Sales is how many units? 5,33,000 units. 530,000 units into what is selling price? 10 rupees is equal to 53 lakhs 30,000. Please. Just involution number, we just minus what? Cost of goods sold. How many units sold? 5,33,000 units into 7.4. Into 7.4. Response is or no? No. Which is equal to how much you got? 29 lakhs? 39 lakhs? 44,200. Now, sales minus cost of goods sold gives you what? Gross profit. It is going to be gross profit. Tell me what is gross profit? 1%. 13 lakhs. 85,000. Okay, 13 lakhs 85,800. Please. This is where morning also I got irritated here. So many people are talking, some are telling the answer as if they are shouting and telling the answer without any clarity. How a person standing here can write? Please. What is the necessity to talk? Tell me. We are doing a sum or not? Okay. From the gross profit, this is what? The gross profit. From this I have to reduce what? The variable selling overheads. Tell me how many units sold? 5,33,000 units into 2 rupees. Is it how much? 10,66,000. Yes or no? From this I also reduce what? Fixed selling overheads. How much rupees is given straight away? 2,40,000. Enna right or not? Now, you also reduce what? Under absorption. What is under absorption amount here? 79,800. I had a profit of what? 0. This is a profit we calculated in the previous sum. Response is or no? Okay. Now, invest We all know that units produced in that sum is how many units? 5,43,000 units. How many? 5,43,000 units. Can I proceed or not? Now, see. Let us write one by one the total cost calculation. I'll write what? The total cost calculation. Total cost netted off against sales is nothing but cost of goods sold plus variable non-manufacturing cost plus fixed non-manufacturing cost plus under absorption minus under over absorption. Yes or no? Now, if it is profit now I reduce. I am now calculating what? Total cost. Please tell me what is total cost? Cost of goods sold. What is total cost here? Cost of goods sold plus what? Variable selling overheads. That means what? Variable non-manufacturing overheads plus what? Fixed non-manufacturing overheads. That's all. No. They can say cost of goods sold. There is an absorbed overheads, not actual. No. So we have to add what? Under absorption. You have to add what? Under absorption. You have to subtract what? Over absorption. Innapa respond? Yes or no? That's why we should be calculating what? Total cost. Okay. Now, when I say total cost, it is cost of goods sold plus. Tell me cost of goods sold plus what? Oh, sorry. Variable non-manufacturing cost plus what? Fixed non-manufacturing cost plus or minus under or over absorption. Innapa right or not? Now, let's write one by one the item. I'll start with what? Cost of goods sold. Please. We will not write the numbers. We'll write the terms. Okay. What is cost of goods sold? 5,33,000 units is what? Units sold. It is what? Units sold. In the 7.4, tell me what is inside the 7.4? 6 and then 1.4. What is 6 m? Variable manufacturing cost. What is 1.4? Or 1.4? It is the absorption rate. It is what? The absorption rate. Respond. Are you following what I am saying? Yes, sir. Okay. Can I proceed? See. Cost of goods sold is equal to 5,33,000 is what? Units sold into variable manufacturing cost per unit plus how I got 1.4? BFO by BO. It is what? A BFO by BO. And nothing but what? Fixed manufacturing overheads divided by denominator level units. Yes or no? Now, can I say this is FM overheads divided by UD. Remember what I am doing? Everybody following or not? Yes, sir. Please tell me yes or no. That is units sold into variable manufacturing cost. How much per unit? 6 rupees. How I got that 1.4? It is the budgeted fixed cost divided by the normal capacity. So FMO means what? Fixed manufacturing overheads divided by UD. He is going to give you the cost of goods sold. In the parade or not? Now, we have cost of goods sold. Add what? Variable non-manufacturing cost. Can I add it or not? Add variable non-manufacturing cost is equal to units sold into variable non-manufacturing cost per unit. Ennappa, right or not? Now, this is the second term. Please tell me, right or not? Because how I got variable selling expenses? 5,33,000 units sold into 2 per unit. Just participate, no need to write. Can I proceed? So it is units sold into variable non-manufacturing cost per unit. Okay. Plus, the third item is what? Fixed non-manufacturing cost. That is what? Fixed non-manufacturing cost. Yes or no? Plus, under absorption should be added. Over absorption should be what? Subtracted. Tell me what is under or over absorption? Fixed manufacturing overheads is actual. It is what? It is same as what? Budget. We assume fixed manufacturing overheads minus. This is actual. No, minus what? Absorbed. What is absorbed overheads? Units produced into units produced into fixed manufacturing overheads divided by UD, the normal capacity. Yes or no? Now, how many units I produce? Every will be charged how much? Yeah, the absorption rate. What absorption rate? FMOS divided by UD. Should I repeat? Can I proceed? Now, again, don't think something is necessary, unnecessary. What I'm doing in the class, everything is what? Necessary. Put the hard effort to understand it. I'll explain even if you require once more, not an issue. Can I proceed? Can I explain? Those who want to explain, raise your hand. Okay. I'll explain once again before I proceed. See. Because from here I go to the next. I'm deriving the formula of a break-even point. Please. When you derive the formula only, you can understand the logic of the formula. Overall, one cannot say, sir, this is how the formula works. We can understand. The logic can be understood only through what? Derivation. Some areas like that only. Can I say? Now, see. Those who did not understand, I'll say once again. Now, I want to know the total cost debited to P&L account in that year. Some cost goes next year through stock. That you leave it. What the total cost debited to P&L account in that year? You have to understand or not? Now, this is manufacturing cost. This is what cost here? Manufacturing cost. Is the entire manufacturing cost going to P&L up? No. Manufacturing cost only to the extent of what? Cost of goods sold is in this year. What is in stock goes to what? Next year. Is it accepted? Yes or no? No. That means there are two costs here. Manufacturing cost, non-manufacturing cost. Non-manufacturing cost expires what? Fully. I need not worry about that. But manufacturing cost expires only to the extent of what? Cost of goods sold. Is it agreed? So this you can understand as manufacturing cost of goods sold. Called as what? Manufacturing cost of goods sold. Okay. What is manufacturing cost of goods sold? Unit sold into manufacturing cost per unit. What is the manufacturing cost of goods sold? Unit sold into manufacturing cost per unit. Accept or not? To manufacture one unit, what is the cost here? I spend 6 rupees as what? Variable cost. I charge it 1.4 as what? Fixed cost. It is what fixed cost? Absorption rate. Yes or no? Yeah. So 6 plus 1.4 only became what? 7.4 into unit sold gives you what? The cost of goods sold. Point number 1. Accepted. What I have written here in words, that's all. Cost of goods sold is unit sold into VMC means what? Variable manufacturing cost per unit plus FMO is what? Fixed manufacturing overhead. So divided by actual production or normal capacity. I got this 1.4 at the beginning of the year by dividing using what capacity? Normal capacity. Fixed manufacturing divided by what? Denominator level units. This is what we call as absorption rate, SR per unit. What is SR per unit? BFO by BO. BFO means what? Budgeted fixed manufacturing overheads. BO means what? Normal capacity. Other we can ask UD in this calculation, unit level, denominator. Absorption rate plus variable cost gives you the amount to be charged. Is a full manufacturing cost per unit. Yes or no? Into what? How many units sold becomes a cost of goods sold. First point, everybody accept or not? I'll go frame by frame. This point, are you following or not? Now the second point, now. The cost debited to this year P&L account is only manufacturing cost. No. I also debited what? Non-manufacturing cost. Well, two types of non-manufacturing cost. Variable non-manufacturing cost, fixed non-manufacturing cost. What is variable non-manufacturing cost? Unit sold into variable non-manufacturing cost per unit. Accepted? Yes, sir. Every unit 2 rupees selling cost. I said how many units? 5,33,000. How I got 10,06,000? It is 2 into units sold. Yes or no? Units sold into variable non-manufacturing cost per gives you what? The variable non-manufacturing cost. Yes or no? Apart from that, I also incur what? Fixed non-manufacturing cost. No need to calculate. Always straight away given. Yes or no? No. This will give me total cost or not? Yes, but the problem is inside the cost of goods sold calculation, cost of production, I did not debit the actual fixed manufacturing overheads. I debited only what? Absorb. There is going to be some under absorption, over absorption, which goes to next year, expires in the same year. All variances, because volume variance is nothing but under absorption or over absorption. Standard costing says all variance debit to what? Current year P&L account, yes or no? In that case, under over absorption should be what? Added in this year. Under absorption is adding to the cost. Over absorption is what? Subtracted. Yes or no? Very simple. Yeah. I have absorbed 10,000. I have spent 12,000. Under absorbed, over absorbed, under absorbed. So I should do what? Adjustment, add it to the cost. It will be subtracted from profit. I have to what? Add it to the cost. Since I am calculating total cost, add under absorption or subtract what? Over absorption. Yes or no? What is under over absorption? Actual overheads minus what? Absorbed overheads. Actually same as what? Budgeted. Not an issue. FMO, fixed manufacturing overheads is what? Actual minus absorb. What is the absorption rate? FMO is divided by UD. This is 1.4 absorption rate into what is the units produced? 5,43,000. That is only calculated in the particular slide. Yes or no? So every unit produced absorb how much? FMO is by UD. This is the absorbed overhead. It's going to be what? Actual overheads. If the absorbed is less than what? Actual. Under absorption added. Absorbed is what? More than actual. Over absorption is what? Automatically become what? A negative number. Everybody yes or no? Now if I add all this, I'll be getting what? The total cost. Please respond yes or no. Now I'll continue further. Now this total cost I will further simplify. That's what further simplify. Please participate. US common here. Yes or no? Yes sir. Ingi unit sold is there. Here also what? Unit sold is there. Common in both places or not? Now I'll take unit sold outside. Unit sold into VMC plus VNMC gives you VC. Variable manufacturing cost plus variable non-manufacturing cost gives you a total variable cost. So what I can do is, I can say US into VMC plus what? VNMC can be called as what? VC per unit plus what? FMOH divided by UD. That is acceptable. Now, I'll just start writing once again. I'll say total cost is equal to, please participate, unit sold into, tell me what? VC plus FMOH divided by UD. This is what? This has covered cost of goods and then what? Variable non-manufacturing cost. Now, plus what? Fixed non-manufacturing cost. Accept or not? Then we are going to have what? Plus under absorption. How we calculate under absorption? FMOH minus what? FMOH divided by UD into UP. This part are you following? If I add all this, I'll be getting the total cost. I can further simplify this as follows. Total cost is unit sold into, again tell me what is it here? Variable cost plus FMOH divided by UD. Up to this no problem, yes or no? Now tell me. Fixed non-manufacturing cost plus fixed manufacturing cost gives you total fixed cost. Fixed non-manufacturing or fixed administration and selling, and then what? Fixed manufacturing, that addition gives you what? Total fixed cost. Plus what? Total fixed cost. Now this is what? Minus FMOH divided by UD into UP. Now this can be asked as a sum. It's going to be what? The total cost under the absorption costing system is the way of calculating. Respond. Are you all following the total cost calculation or not? Now tell me, total cost. It is better to buy hard with concepts, so you'll be having grip over it. Yes or no? Now, total cost. What is total cost? Unit sold into variable cost. Variable manufacturing or non-manufacturing are both the whole. Plus, what is FMOH by UD? It is called as what? Absorption rate. Total variable cost plus absorption rate into unit sold plus what? Fixed non-manufacturing cost plus what? Fixed manufacturing cost gives you what? Total fixed cost minus this is called as absorbed overheads. FMOH by UD into what? UP is going to give me the total cost. Okay, now let me go to the last step of finding out the break-even point now. Can I proceed? Now, tell me, total cost is equal to, I want everybody to tell before I write, total cost is equal to what? Unit sold into VC plus FMOH divided by UD plus total fixed cost minus FMOH by UD into UP. Everybody respond, yes or no? Without seeing it, then the mind or not, it should be like a blotting paper. Can I proceed or not? Now, next step. I will call this unit sold as break-even point. There are so many units sold there. I'll call this unit sold as what? Break-even point. Only when my total cost is equal to sales. Only when the total cost is equal to what? Sales, the profit can be what? Zero. So I can call this unit sold as break-even point only when my total cost is equal to sales. Accepted? Yes, sir. Can I proceed? Can I equal like that or not? Now tell me once again. You all remember very much than me, young persons. Can I proceed? Now, what is sales? Unit sold into selling price. Now, I'll just write at break-even point. What is going to happen here? Sales is equal to total cost. This is our conclusion. Yes or no? Now, sales is what? Unit sold into selling price is equal to, what is total cost? I forgot. Unit sold into variable cost plus FMOH divided by UD plus fixed plus total fixed cost minus FMOH divided by UD into UP. Enapa accept or not? Now, see please. What happens is, I bring this side. Okay, I can say like this. Unit sold into what? Selling price is one aspect minus what? Unit sold into, tell me what is that? Variable cost plus FMOH divided by what? UP. This I brought this side. Yes or no? Divided by, sorry? That's what I wrote, no? Divided by UD. Right? I just answered wrongly. Divided by UD. I brought this side, which is equal to right hand side is what? Total fixed cost minus FMOH divided by UD into UP. Respond yes or no? Now, unit sold is common here or not? Yes, I can say unit sold into, what happens here? Selling price minus variable cost minus FMOH divided by UD is equal to, what the right hand side here? Total fixed cost minus FMOH divided by UD into UP. The unit sold called as what? Break-even, because the sales is equal to what? Cost. So what is unit sold? Please tell me. Unit sold is equal to, this is going to be right hand side. What are numerator? Total fixed cost, please, minus FMOH divided by UD into UP divided by, this goes denominator, what happens here? Divided by what? Selling price minus variable cost minus FMOH divided by UD is a break-even point of what system? Absorption costing system. Thank you. Can I proceed or not? No. Do you understand the calculation? That's how the formula has been arrived at. Here, if you look at the formula, I don't want to know the stock. I don't want to know what the stock. I can find out this unit sold by given what? The units produced. Yes or no? That's how when the production is given, one should calculate what? Absorption costing, break-even. Marginal costing, no change. What is break-even point? Fixed cost divided by contribution, because marginal cost is never going to be affected by production or what? Units in stock. Everybody following out, because fixed cost is never related to what? Product at all. This absorption costing break-even point calculation. Everybody following out? No. To conclude, we can copy this derivation later. To conclude, tell me, what is the break-even point under absorption cost? Tell me. Total fixed cost minus fixed manufacturing overheads divided by UD into UP divided by selling price minus variable cost minus fixed manufacturing overheads by UD. Rumba simple. Another way to understand is total fixed cost is that, yes or no? Minus, this is absorption rate. This is what? Absorption rate into UP is called as what? Absorbed overheads. So total fixed cost minus what? Absorbed overheads. Simply understanding, total fixed cost minus absorbed overheads divided by selling price minus variable cost minus absorption rate. Selling price minus variable cost minus absorption rate is a formula. Tell me simply the formula. What is the formula? Total fixed cost minus absorbed fixed overheads divided by what? Selling price minus variable cost minus absorption rate. Right? Or in the notebook written the formula or not? Write down. Or BEP is equal to, or BEP is equal to total fixed cost minus, BEP is equal to total fixed cost minus, tell me what is the number? Absorbed fixed manufacturing overheads. Total fixed cost minus absorbed fixed manufacturing overheads divided by selling price minus variable cost divided by selling price minus variable cost minus what? Absorption rate. We also call absorption as what? Standard rate per unit. You calculate or not? So minus absorption rate. Selling price minus variable cost minus absorption rate. With this we complete the introduction discussion to this area called as marginal versus absorption costing break-even point when we have been given what are the production units. So can we complete the calculation in this stage or not? No. They are given for 6 years to calculate the break-even point. Don't think how to calculate 6 times. The first 4 years same break-even point. Production is same in what? First 4 years. 5th year and 6th year have to calculate what? Break-even point. Once you finish calculating, we'll write the notes for this formula derivation and then discuss the implication of what? Marginal costing versus absorption costing break-even point for the managerial performance evaluation. Can we start or not? No. Can you do this sum or not? No. Please. So already did all this discussion, right or not? No. First. Facts also has been written. Another 2 minutes, let us complete the sum. Okay, now. Break-even point under absorption costing system. Please. Break-even point under absorption costing system. Once again, don't think as under absorption costing system, break-even point under absorption costing system. Under should understand as in here, okay. Break-even point in absorption costing system. Can I proceed? Now. Period, computation, break-even point. Period, computation, break-even point. Period, computation, break-even point. Okay, shut or not? First 4 periods you have to calculate again, same number. And production is going to be same. As long as production is same, BEP also remains what? Same. 1 to 4 years. 1 to 4 years. Okay. Now, instead of putting in the slide, you tell me, and then you can just copy the break-even point calculation. I'll go for the facts. Okay. Now, 1 to 4 years to calculate break-even point or not. You have all the numbers in a facts. Please tell me just to have a grip. And then we'll put in the slide and you can copy it. Okay. Tell me break-even point formula. Break-even point is equal to what? Total fixed cost minus FM overheads divided by UD into UP divided by selling price minus variable cost into FM overheads divided by UD. Accept or not? Now, you tell me one by one. What is total fixed cost? Look at the problem. What is fixed manufacturing cost? 3 lakhs. What is fixed non-manufacturing cost? 1 lakh. 3 lakh plus 1 lakh. What's the number here? 4 lakhs. Don't copy, please. Listen, you have to tell along with me. Looking at the notebook, I have the slide here. I have the notebook, the facts there. Yes or no? Now, 3 lakhs plus 1 lakh. Total fixed cost is 4 lakh. Yes or no? 9. What is fixed manufacturing overheads? 3 lakhs. Okay. UD means actual capacity, normal capacity, normal. Or normal capacity, 1,50,000 into first 4 years, what the production? 1,50,000 units. Now, in the first 4 years, there is no under or over absorption because what a plant I produce, right or not? Now, into 1,50,000 units, please. Divided by, tell me what is selling price? 10. Minus variable cost is 6. And only manufacturing variable cost is that no non-manufacturing cost. So the total variable cost is 6. Minus what is FMOH? 3 lakh. Divided by what is 1,50,000. Right or not? Now, please simplify and tell me it is 4 lakhs minus what? 3 lakhs. Divided by 10 minus 6 minus 2. Is how much here? 50,000 units. How many units? 50,000 units. Please. If I sell how many units? 50,000 units, I'll be having a profit as 0. I have 50,000 units sold, the profit is what? 0. This is a 0 profit for what? First 4 years level of sales. Right or not? No. Let us check whether this 50,000 is break-even point. You have to check it or not? No. Tell me, I am selling how many units? 50,000. But I decided to produce how many units? 1,50,000. These discussions are important. Please participate. I am going to sell 50,000 units. I am going to produce what? 1,50,000 units. By doing so, my profit is what? 0. Can I check it or not? Yes, can I proceed? Now, see. First of all, you need not copy, please. I'll give you time to copy everything later. Now, tell me, units sold. I am going to sell how many units? 50,000. Units produced, how many units? 1,50,000. I am going to have a decrease in stock, increase in stock, increase in stock. I don't say it is closing stock. I am saying increase in stock. That may be opening stock also there. Yes or no? Now, tell me what is the increase in stock here? The stock increase is how many units? 1 lakh units. All this are going to have some logical discussion later. Can I proceed or not? No. These are all the details given. And denominator level units you all know. For what is the denominator? How much going to be? 1,50,000. Hence we have 2 rupees absorption rate. Right? Now tell me first. Income statement. Sales. How many units sold? Into what the 10 rupees. What the sales here? 5 lakhs. Yes or no? No. Minus what? Cost of goods sold. Absorption costing, minus what? Cost of goods sold. How many units sold? 50,000. Into each unit, the variable cost, how much rupees here? 6 rupees. And the absorption rate, 2 rupees. This is variable manufacturing cost. The variable manufacturing cost, how much rupees here? 6 rupees. Absorption, how much rupees here? 2 rupees. Is 50,000 into what? He is going to give me how much rupees? 4 lakhs. Right or not? No. The difference I call as what? Gross profit. What is the gross profit? 1 lakh minus what? The cost minus what? Variable non-manufacturing cost is 0. Nothing given. Yes or no? Minus fixed non-manufacturing cost. How much is given? 1 lakh. Yes or no? Next is what? Plus or minus under absorption or over absorption. Under absorption I have to what? Add or subtract from profit. I'm doing from profit or not. Don't look at the cost formula. I'm going to subtract what? Under absorption. I'm going to add what? Over absorption. Very simple. Add or subtract over or under absorption. Now, very simple. Absorbed overheads minus what? Actual overheads. What is the actual fixed overhead spent here? Tell me what is the actual fixed overhead spent? 3 lakh rupees. If I want to pay here, 3 lakhs. Now, actually is 3 lakhs. Absorb. How many units I produce? 1,50,000. What the absorption rate? 2 rupees. So under is going to be how much here? 0. What the profit? 0. Under absorption cost, the profit is what? 0 rupees. Innappa, right or not? This is how one should calculate absorption costing profit. For 0 profit, it should be the sales. Like this, first year, second year, third year, fourth year, all the 4 years. When they produce, how many units? 1,50,000. And sell how many units? 50,000. I'll be reporting a 0 profit. Respond, yes or no? Please tell me, yes or no? No. One more thing, I'll complete and then give you time to copy it. You do for 5th year and 6th year or not? Now, tell me, break even point for what? Year 5. Just only formula, no income statement. Tell me 5th year, what are the production units? 1,70,000. Break even point is equal to what the total fixed cost? 4 lakhs. Are you awake or not? Minus. What is FM overheads? 3 lakhs. Divided by what is UD? 1,50,000 into what? 1,70,000. I am under absorbing or over absorbing? Over absorbing. Yes or no? Whole divided by selling price is 10 minus 6 minus 3 lakhs divided by 1,50,000. I think you are all following or not? Now, please tell me the numerator here. It is 4 lakhs minus 3,40,000 divided by 2. So how many units here? 30,000 units. When I sell 30,000 units and produce what? 1,70,000 units, I can achieve a 0 profit. Yes or no? Now, carefully follow. Break even point for what? Year 5. Like that, one can do it for what? Year 6. You can know how to calculate it, right or not? Now, I'll complete my discussion and then we can just go for the solutions. Okay. Now, who uses marginal costing? Who uses what? Absorption costing break-even point. Let us see the use of absorption costing break-even point and then copy the solution. Before that, have you understood what I done now or not? Simply 1 to 4 years, I found out the break-even point to be how many units? 50,000 units by applying the formula, right or not? That is, when I sell 50,000 units and produce what? 1,50,000, I'll have a profit of 0. 5th year, the break-even point is dropped how many units? 30,000 units by producing 1,70,000. And the last year we can calculate as usual. We'll do together in the slide. Can I put or not? Now, we have calculated break-even point and we also confirm that 1 to 4 years at 50,000 unit sales, what is my profit? 0. This is only for you to believe me. Respond. Are you following what I'm saying? Not required for the solution. Now, come back to the discussion. See. For 2 reasons, costing system may be used. It can be may be used for what? 2 reasons. One is to evaluate performance. Standard costing. Variance evaluation, no? To evaluate what? Performance. And based on that only reward may be given to the managers, divisional managers, right or not? Another is for decision making. Another is for what? Decision making. Now, one thing is sure. Decision making means we have to follow only marginal costing system. Absorption cost system worst. It is going to be what? Worse. It will mislead us because it is unnecessarily linking volume to fixed cost. Whenever you use the word decision making, always what should come out of our mouth is what? Marginal costing system only. We should not go by what? Absorption cost. Suppose I want to start a new product. I want to know what is a break-even demand. I should not use all these formulas. Simply what is break-even point? Fixed cost divided by contribution per unit. Because only an accountant's role to carry fixed cost from what? 1 year to another. For economics, it is going to be what? Fixed cost income in the same year only. Respond, yes or no? So always for decision making, tell me for decision making, the word break-even point means what break-even point? Marginal costing, absorption costing, put in dustbin. Are you following? Okay, now come to the next. See, managers are generally given targets. Are generally given what? Targets. This is what you should achieve. Okay, they give the targets. Based on that only, they'll be given promotion, or their promotion may be what? Withheld and so on. So divisional targets will be given. They'll try to achieve their what? Targets. So for every manager, reporting his division profit in a very good manner is very, very important. Respond. Are you following what I'm saying? See, for him, when he starts here, he would like to know how many units he should sell in order to break even. Are you following what I'm saying? See, you are a manager, yeah? You have been made responsible for this particular, suppose, MTH Chennai, Nungambakam division, you are the head, okay? Let's assume like that, okay? Now, and your reward was based on the division's performance, okay? Now, first thing you should understand is, you believe, how many students should enroll for the division to break even? Respond, yes or no? That is the first threat for you. You should not report loss. You should never report what? Loss. Even if you don't report profit, okay, you should never report what? Loss. So the manager would like to know how many students should come in this particular classroom for the company to what? Break even. You like to know it or not? So MTH is a wrong example. No stock here. We can have stock of student. Not possible. That's I gave an example. Please. Shh. Why you are shouting? Can I proceed? Now, in this scenario, what happens is, this year, the manager feels that the demand is going to be low. He feels that what? The demand is going to be low. Understand not? Now, a company having normal capacity of, for example, 1,50,000 units. What is normal capacity? 1,50,000 units. Due to his inefficiency, some reason, I don't know, but he believes that the current year, the demand is going to be only 50,000 units. He knows, he guesses the demand is something around what? 50,000 will be what? Demand. He guesses the demand is going to be how much rupees here? 50,000. Normally say, a 1,50,000 capacity company, normal capacity, if the sales drops by what? To 1/3, will they incur loss or not? Normally, will they incur loss or not? ரொம்ப simple. Every year I am selling 1,50,000 units here, normal capacity. But this year my manager forecasts that the demand is going to be only how many units? 50,000 units. So now he knows that the sales is likely to result in how many units? 50,000. Now he is afraid now because he may be dismissed. It may be due to his inefficiency or anything. I don't know. But he is afraid of what? Reporting a loss. Okay. What he can do, he says, with the 50,000 unit sales, how can I break even? He goes reverse. He just says, if 50,000 units sales, how much I can break even? He simply says, let me produce 1,50,000. Whether demand is there or not, I'll produce. Whether demand is there or not, what? I produce. I'll produce what? 1,50,000 and then break even. You may wonder, how is that through production I can break even? Question arises, no. Because 50,000 the demand, but if I produce only what? 50,000, then there is no stock increase. That 50,000 requires the entire fixed cost this year. What I can do is, demand is only 50,000. If I produce what? 1,50,000, I build up a stock. There is not, stock is not 1 lakh. I increase what? 1 lakh stock. When I build up a 1 lakh stock, the advantage is 2 rupees inside every unit escapes this year, goes next year. This year escaped. In that case, he has straight away avoided what? 2 lakh fixed cost recovery. He has postponed to what? Next year. He says the break even is what? 0. Not even break even point. I can even accomplish target profit. I want to report 80,000 rupees profit. Add to what? The entire discussion. And then increase what? Production. By increasing production, anything can be what? Achieved. Everybody follow what I am saying? So, very simple. Yeah. Next year, suppose, 5th year, my demand is only 30,000. He need not worry how to make profit and all. Increase the production to what? 1,70,000. Still he can break even. Respond, yes or no? No. So in absorption costing, to break even, it is not necessary to have sales. It is enough you also have what? Production. Through stock, you can postpone cost recognition and try to report profit. Enough or right or not? Now, if you evaluate a divisional manager performance based on your normal P&L account, this is a risk. The risk to what? The company. The reason is, this 1 lakh stock is being produced for the future demand. Has been produced without demand. This year 50,000 only. Yes or no? Produce what? Without demand. Two things. Unnecessarily holding cost is incurred. Yes or no? Yes, number 2 is, this year 1 lakh. Okay, look at this company. This year also 50,000 only expected demand. Next year also 50. Third also what? 50. One also what? 50. Like that every year he is going to increase the stock. Not stock like. He is going to increase stock by what? 1 lakh, 1 lakh, 1 lakh, 1 lakh. At the end of 4 years, 5 lakh stock will be lying in the go down unsold. Yes or no? it may be deteriorating, it may become what? Obsolete. One fine day, you feel that all the stock has become what? Obsolete. You debit to the P&L account. Yes or no? By the time the manager resigns and go home, enjoying all the benefits, bonus, etc. Are you following what I'm saying? In that case, you are recognizing a problem later due to following what? Absorption costing. This break-even point concept can be manipulated by what? Production managers or the division managers to report a rosy picture about the income statement is otherwise not so good. Everybody yes or no? So the main disadvantage of absorption costing is it allows what? Fixed cost to escape. It allows to want a fixed cost to escape from 1 year to want a next accounting year, and really it cannot escape because fixed cost in fact really incurred in what? Same year, and that also escaping is done through what? Building up stock. So building up stock not only allows fixed cost to escape, it also makes you incur what? Holding etc. One fine day when you write it out, it will be too late to understand what? The variance. Hence we should not follow absorption costing system even for what? The performance management. Performance measurement is the conclusion of this absorption costing break-even point. Everybody following on? Now, what I am discussing, don't think I am just discussing something out of syllabus. Question may ask, why absorption costing break-even point should not be used for what? Performance evaluation. Okay, because in recent attempts and all, very unique questions are being what? Asked. Every discussion made is going to speak about logic of a particular system. Tell me, for decision making, always what? Performance evaluation is generally done based on the divisional P&L account. In that case, they would like to know the break-even point to manipulate that one production. That is also should be avoided. Don't base a manager performance based on absorption costing, based on what? Marginal costing. That is why when it is standard costing problems, most of the advanced sums like balance scorecard, planning operating variance sum, in all those sums, we prepare a reconciliation statement using absorption costing and marginal costing, that only properly evaluated because nobody can be made responsible for fixed overhead volume variance. It's nothing but what? Fixed overhead volume variance only makes you report a zero profit, where you should have reported what? Loss. So this is regarding the discussion regarding marginal costing versus absorption costing. Respond yes or no? Now we can just write the calculations. Tell me.